ahead and get started. Thanks for joining the Director's Cut, February 15th. And I'll just kick it right over to Lynn. So go ahead.
Thanks, Katie. And thanks to everyone who's here for the Director's Cut and who signed in. We're talking about December production. So we're going to talk about the way the oil and gas industry closed out 2018. And what a great way to end the year. Record production, just topped that 1.4 million barrel a day mark. And so we had been a long time approaching that and uncertain about when we were going to cross it, but we got above 1.4 million barrels a day. That was a 25,000 barrel a day or almost 2% increase in oil production. What came with that was a big increase in natural gas production, up 129 million a day, up 5%. So we've returned to the days of gas production increasing much more rapidly than oil production. And that's going to be really our challenge going through the entire year of 2019, is to bring on gas gathering and processing capacity to try to keep up with those. I ran the numbers and estimated how much self-restriction industry imposed on itself. I guess that's sort of a redundant way of saying that. If you impose self-restriction on yourself, that's too redundant. And so our estimate from anecdotal information and also from the numbers we receive is that that amounted to about 35,000 barrels a day in December. So production could have, had we had adequate gas capture capacity, could have been 35,000 barrels a day higher. But it came in at just over 1.4 million and 2.65 BCF a day, which is a new all-time high for natural gas production. We're just one well shy of the well record, so right at the record number of active producing wells, and still about that same ratio of about 90% unconventional Bakken and Three-Fourths wells versus about 10-12% conventional wells. Interesting number. I just looked at the number today, and our estimate for how much was spent on drilling and completions in since 2006 is about $109 billion invested in North Dakota since 2006, since the beginning of the Bakken boom. About 109 billion in just drilling and completing oil wells. We don't have final numbers yet on midstream or pipeline, but we'll have those probably by next month. We saw permitting increase dramatically from 92 permits issued in December to 219 in January. That's not unusual. We don't want to make too much of it. That's a makeup for the holiday time. That time between Thanksgiving and Christmas, operators don't file a lot of permits. And so they like to make up that slack in January. Oil prices, we saw the North Dakota Sweet price, which is the Flint Hills posting, increased 100% from December to today. Now, West Texas Intermediate did not. It went up about 20%. But all in all, oil prices are definitely strengthening. And as you can see from the charts that I have on page 2, you can see that we're high in terms of storage, domestic storage, and also that EIA is predicting from now all the way through 2020, we're going to be in a slight overproduction scenario based on what they think demand growth is going to be. So having talked about the increase in oil prices, it wouldn't be reasonable based on the numbers to expect some kind of big increase between now and the end of 2020, because there is going to be spare capacity, surplus capacity available within OPEC, in Russia, and also in the shale plays to cover any kind of demand increase. So slowly increasing prices, but there's nothing in the numbers that would predict a big increase in oil prices. Rig count is steady in the mid-60s, and so that's encouraging that continues. The modern drilling rigs are just not that sensitive to weather conditions. They are doing multi-well pads. drilling wells in 4 to 6 well batches. They're winterized, and so they're just not that reactionary to weather conditions. Not the same with completions. So we saw a high number of completions, 110 wells completed in December, which is a preliminary number, will probably go up. January is probably going to be okay, down from that some, but February is not going to look good. We know that the really cold weather set in mid-January or so, and we have seen little to no relief from that. And so while there's been some hydraulic fracturing going on, it's significantly reduced. And so we're expecting production in January to be flat, maybe down slightly, but February we will probably see a drop in production before it starts to recover again. You can see the results of that completion activity are wells waiting on completion dropped 134 in just 1 month. And so they really dove into that inventory and brought that down. That's why I said I think the December completion number is going to be even higher than that 110 that we saw, and that's what drove the makeup of the November production drop and the 25,000 barrel a day increase that we saw. Oddly enough, reservation activity moved in the opposite direction again, only slightly, but the rig count is down on the reservation, total production is down, and the wells waiting on completion pretty much steady, which is just moving in the opposite direction of what happened statewide. And I'm not sure what to attribute that to, other than there is a lot of activity going on right now dealing with tribal tax agreements and discussions about how regulation is going to move forward on Fort Berthold and those sorts of things. In the gas capture area, good news, all-time high in terms of gas capture. All of the numbers were up except for the fee lands within Fort Berthold. So we made up a little ground on gas capture. We're still not at the 88%, and most of that is workforce issues delaying infrastructure development. But we have begun meeting with the midstream companies. Last summer when we met with them, we had thought, well, maybe there won't be a lot going on and maybe we don't have to meet in the middle of the winter. They don't like to travel here in January and February. But with the delayed activity and all of the pressure on production from gas capture, we decided to call all those companies in and meet again. So we met with 3 companies. Interestingly enough, 2 out of the 3 now have surplus capacity that they're trying to fill. So Wild Basin, that gas plant finally came on at full capacity on the 8th of December. So it was, the ribbon cutting was in October, but they didn't reach full capabilities until the 8th of December. That was a $150 million plant. They're operating at about 190 million a day. They've got 320 capacity. So they're actually out shopping for third-party gas that they could capture. And so that's probably helping us in McKenzie County. Kinder Morgan, they're waiting on they're waiting on their new plant, the Roosevelt expansion, and so nothing there. Liberty was in. They've got about 20 million a day of surplus capacity, and so they're shopping that around looking for third-party gas too. So we're starting to see the midstream companies generate excess capacity, and so I think we can be confident that by the end of this year, we should get this gas capture thing back within the goals that the commission has set, and start to look at what we're going to do moving forward. So that's pretty encouraging news. We have restarted our meetings with the BLM with regards to taking over gas capture regulation on federal lands. Our new target for achieving that is the 1st of April. So we're really close. And in fact, our final terms of a proposed agreement are in the Washington Solicitor's Office. Now, they spent the week preparing for another government shutdown, so they didn't take time to look at the proposal that we had worked out between the Montana Dakota's office and the North Dakota Industrial Commission. But I'm confident that they're going to get to that next week. So we're on track to get an agreement in place there. One other piece of information we provided that we do once a quarter is an update on break-even prices. And I think Katie included a statement about what those actually mean, what we're really calculating. I think the encouraging thing that you can see is, for the most part, the break-evens are the same, or there have been significant improvements. So if you look at like Burke County and Billings County, you can see that the break-even prices dropped $3 to $8 a barrel. And that's the application of 3-mile laterals and 4th generation completion technology. We're just seeing particularly Burke County really respond to the new longer laterals and the cemented liners with the perf and plug type completion. So real solid. I mean, virtually any county that you want to drill a Bakken and Three Forks well in is economic at today's oil prices. So that's encouraging. And so as we move forward and we start to get some warmer weather, we're going to see production growth. But in the short term, January should be okay, but February is going to be tough. The temperatures and the snowfall that we've had have just been really difficult for companies to work in. I did have the opportunity to talk to the operator in Stanley that let people go and find out what that was all about. Back before the price collapse, they had targeted increasing their North Dakota production to 100,000 barrels a day. And so they had staffed up to that kind of production level. The highest they ever got to was 80,000 barrels a day. And they've declined now down to about 45,000. And they just needed to adjust their staffing and personnel levels to that. I think they've taken a look at their capital investment. They're going to grow production a little bit, but they do not plan to ever reach that 100,000 barrel a day number. So it was an adjustment down to the reality of the post price collapse kind of production that they're anticipating. And so they're expecting going forward to hold their production in that 45,000 to 60,000 barrel a day range. And so they believe that they made the right adjustments to their staffing to operate in that level. So that's what that was all about. I think you can look at that, and there may be a few other companies follow their lead a little bit, but most of the major Bakken and Three Forks operators have a lot of drilling inventory, and they're going to be actually growing their production, not holding it steady or shrinking it. So I don't think it's going to be a widespread trend that we ought to look at across the industry. It's going to be a little spotty from one place to another. That's probably way more than you want to know about that. But with that, I'll take questions.
I do have one question that comes in regards to EOG. Have they said anything at all about the rail terminal, and if rail export is still something that they're looking at pursuing and doing?
They are out of the rail export business, essentially. And so the EOG rail terminal may be looking at potentially a new operator, which would be for the export of natural gas liquids or something like that, and is used currently for importing materials, frac sand, cement, casing, but it is not going to be an active crude oil export terminal again. And so, that again was part of growing to 100,000 barrels a day. And, their new production expectation and target is well below that.
Go ahead.
Following up on that, do you know how many employees they reduced and whether it was EOG employees or contractors?
Yes. So I was told that it was 20 company employees and approximately 80 contractors, and that it represented about a 25% reduction in staffing levels, commensurate with where they think their production is going versus what they had staffed up to do. So.
And primarily the impact was in the Stanley area.
It was, and again, part of it is a technology application. They have implemented a lot of automation on their well sites. As you know, their partial field was the first discovery, and it's the oldest, and so there's been a lot of automation and that sort of things implemented on their well sites, and so their need for manpower is decreased by that as well. But it was really more about sizing their staff and their contractor fleet for production expectations, which are substantially lower, 30 to 40% lower than what they were projecting in 2014. And again, we may see some other companies do a little bit of that, but our other major operators are all planning to grow production, not stay the same or get lower.
Can you talk about the record volume of crude output in what's normally the coldest and lowest producing month, kind of how that played?
Yeah, you're right. I mean, December quite often has been a big drop in crude oil production. The interesting thing with this December, or this most recent December, is that the first 3 weeks or 3.5 weeks, the weather was awesome for North Dakota. There was little to no snow, and the temperatures were above freezing more than they were below freezing. It wasn't until the day after Christmas that winter really started in North Dakota, and it began with that snowstorm that caused a lot of disruption to traffic the day after Christmas, and there hasn't been a lot of relief since then. So December typically is our first month of the year when we see a production drop, but in this case we had beautiful weather in December, and it's been January that was a little bit better than a normal January, and February has been much worse than the typical February. It was 27 below in my driveway this morning. So nobody does a frac job or starts a frac job at 27 below.
Any other questions in the room?
You mentioned on Tuesday to the Industrial Commission that you were expecting production to be 1.399. What happens since Tuesday?
Yeah, well, you remember I said we just lacked one well completion of reaching 1.4, and so we did have some supplemental filings. We had some corrections from a couple of companies, and there were a couple of wells missing from the data that they had submitted, and it was just enough to push us the production actually increased about 1,000 barrels a day, a little more than that. I guess it increased about 1,600 barrels a day from where it was on Tuesday. So yeah, just a couple of late filings on some new completions is all it was.
Since the new revisions on pressure testing have come into play, is there anything to report on the status of it and how it's going?
Yeah, so we've had a couple of reports. We're going to make a presentation to the technical solutions group here in about a week to actually have a conversation with the oil companies about how it is going. But we did have a report, which I'm happy to let you know that one of the pipeline companies who has a tariff got a batch of oil that was above the vapor pressure tariff. They rejected it and got back to the company and made them go back and correct whatever it was that they were doing up there near Tioga to get their oil back in compliance with their particular tariff, which is 13 psi, a little bit lower even than ours. So I'm encouraged by the fact that what we had talked about, the fact that pipeline companies have now implemented these vapor pressure tariffs, and they're measuring every single day. And when they got a day or two above their tariff, they took action to stop the oil flow and get the problem corrected. And so we might not have caught up with that for a quarter, but they're measuring it every single day. So that's kind of the only piece of data I have. I think I'll know more after our folks talk to the technical solutions group next week. But that was a major oil company and producer and a major pipeline. And so, we're talking about a pipeline that carries about 25% of our oil out of the state. So I think that's significant.
Any other questions in the room? All right.
Thanks everyone
Justin?
for coming.
All right.
Well, good afternoon, everyone. Justin Krinkstead, Director of the North Dakota Pipeline Authority. Very standard update for my agency here this afternoon. When we start looking at the production basin-wide on slide 2, you'll notice again very consistent numbers out of eastern Montana, South Dakota. I did notice putting together the report today that Montana is back down to 0 drilling rigs active in that state. They had seen a small uptick a few months ago, and that has now gone back to 0. Same with South Dakota, 0 active drilling rigs. When we look at slide 3, this again is just that month over month change, as Lynn alluded to, and especially in the red on the bottom half of this graphic. A significant increase in natural gas production, second highest increase that North Dakota has seen month over month from a growth perspective. When we look at how crude oil is being marketed out of the region, very, very consistent numbers, November to December, for crude oil movements out of North Dakota. Very, very minute changes percentage-wise, as you'll notice on slide 5. Again, rail and pipeline market shares almost identical month over month. And same when we look at what type of volumes were being refined in the region, as well as barrels that were being moved north up into Canada. Slide 6, we did see just a slight estimated increase in crude by rail volumes. Again, just hovering just over 300,000 barrels per day of rail movements out of the region. The EIA is indicating that those barrels are continuing to move westward as the primary destination out of North Dakota, with remaining balance going either to the east coast and a very, very small percentage of crude by rail heading down to the Gulf. When we look at pricing in November, North Dakota was starting to move into a challenging market situation where PADD 2 refineries that you'll notice in the center portion of this graphic had taken about 1 million barrels per day of refining capacity offline. That had a very severe impact on pricing. You'll notice a much wider spread between the PADD 2 region and some of those other coastal PADD 1, 3, and 5. That you wouldn't normally see that type of widespread between those regions. But in the month of November, and I suspect when we see the month of December come out, we'll see again these very wide price spreads for barrels being marketed in that PADD 2 region. So in November, North Dakota was around a $9 discount off of WTI, and then as Lynn alluded to, just over $14 in the month of December. So November, December, very challenging marketing months for the region. As we moved into January and now into February, that has corrected itself and we're back into a much better price scenario for North Dakota barrels being marketed around the U.S. We look at slide 9. This is just an update as of this morning. The Brent WTI spread just over $10 this morning. So again, from a marketing perspective, we're going to continue to see barrels moving out of North Dakota by rail. As long as that spread is $5 to $6 plus, again, there's market advantages to putting that crude oil on a rail car and moving it to the west or east coast. Well, I would expect that we'll continue to see that out of the region. Slide 10, some interesting numbers here on the, again, month over month changes and the the volumes that are being reported as movements between the U.S. and Canada. Notice, the black line, the exports, barrels going north into Canada, much higher in the month of November. There's a little bit of a lag in reporting here during the federal shutdown. This agency was one that was impacted by that, so they're a little bit delayed in their numbers. But I did grab a screenshot on slide 11 in case anyone was questioning where I was getting that data for the large increases on slide 10 for those exports into Canada. That's just some background data and details from the International Trade Commission's website. Slide 12, again, very consistent numbers on the flaring side as far as where those MCFs are being burned and the reasons behind that. So when we look at 5% of the gas that's being flared from wells that do not have a pipeline connected to it, and 14% of the gas being flared from connected locations. Slide 13 is just a historical look at that. Again, the only small change was on the percent of flaring from connected wells. Slide 14, when we look at the pace of getting new wells connected to gas gathering, when we look at the data for December, the new wells that producing natural gas did outpace the new wells selling natural gas. And so that's a scenario, again, that long-term is an undesirable situation. We want to have the gas gathering industry keep pace with the completion crews. We did not see that in the month of December. We'll see, hopefully that industry corrects itself and we move into 2019 with the industry catching up. Slide 15 is just a quick updated outlook for natural gas production as well as our gas processing plant capacity. Lynn pointed that it's going to be late 2019 before the gas processing capacity catches up with expected production volumes. And then long term, we're still forecasting using the EIA price outlook, significant natural gas growth. And so post 2022, 2021 industry, we're going to continue to see more investments in processing plants, gathering pipelines, and transmission systems in order to move all this gas to market. So with that, I'd be glad to answer any questions.
Got one on here. Are you hearing anything new about Canadian crude more south to US by rail or truck?
Not on the trucking front, and again, I haven't heard anything direct from any of the marketers. So again, with the scenario that was taking place in November, December, with some very steep price discounts for Canadian crude, there were scenarios of higher truck volumes, higher crude by rail out of Canada. The market has corrected itself, not only from North Dakota, but improved netbacks for Canadian production as well. So I don't have any updated numbers on what that has done to crude by rail out of Canada, but it will likely have an impact on those marketing decisions.
Perfect. Any additional questions for Justin?
Any updates on the open season for the Liberty project?
No, so the question was for those on the webinar, any update on the Liberty open season? No, I've not heard any of the results yet.
Anything else?
Okay, well, thank you very much.
Not. Thank you, folks.